really the goal here is to just give you maybe some things to think about. Hopefully walk away with one or two good ideas that you could either implement in your own life or kind of store in the back of your mind for a later date when it might be pertinent to you, okay? The title of the presentation is Write Your Financial Future, okay? One thing that I've learned, I've been in the business for I've been in the financial services industry for in excess of 20 years. And one thing that I've learned by working with authors is there's very little difference between an author and a business owner. It's really, you know, they go hand in hand. You may not necessarily be or want to be the CEO of your company or whatever that may be, but I find a lot of the authors are more like the chief visionaries. They're the people who have the ideas, who are putting the pen to the paper and figuring out how to put those ideas into a workable format that can then be saleable. So the question is, you know, when you're publishing a book, it's a major accomplishment, but then you have royalties coming in, you have agents that you have to work with perhaps, there are a lot of business aspects that you have to work with regard to writing a book. And then where do you turn to? You know, how do you handle that? Who helps you write your happily ever after? You're doing this for your readers, but now how do you turn this passion that you have? Because most people start out in whatever they're doing. When they become successful, they start doing it for all the right reasons, which is they enjoy it, they want to have fun, they don't think about the money, and then the money starts coming in, and money has a tendency to be a very paralyzing thing. It's something that I've seen a lot of people are either very fearful of, they don't know how to handle it, and it's very important that if you're striving in that direction to build your business or you are following to that level, how do you make sure that you don't fall into some of the pitfalls that we've seen some authors fall in? You know, we've seen, you know, I'm sure you've heard the stories. Somebody has a hit book, they get a huge royalty check, they start buying houses for cash, cars for cash, and next thing you know, they get a call from the IRS, they have to pay taxes. Oh, really? I didn't realize I had to do that. So we're going to talk a little bit more about that. The first thing that you really want to think about, and it may be pertinent for you today to start thinking about that, depending upon how your personal situation is, or at least starting to kind of lay the groundwork for yourself as far as who you may be able to count on to fill some of these positions. And it's really something that is different for everybody. Nobody's at the same place in their writing career. So you just kind of keep this in the back of your mind. And you may want, you know, we find that your financial advisor, and we'll talk about that a little bit more, we have a tendency, we can quarterback a lot of the relationships that you have, because you want to make sure that you're doing what's going to be generating revenue for you, which is writing and putting out books. You don't necessarily want to worry about, well, the risk management specialist, if I have staff, do I need an HR person? You know, certainly, you know, one of the first, or two of the first two people you're going to need in addition to an advisor is your attorney and CPA. Those are really critical to growing your practice or your business to a level of significance, because without those two folks in place, you know, taxes and legal things are always going to come up, and they're really two primary folks on that team. And then you may need a banker or a business specialist, somebody, and that business specialist could take different forms. It could be a marketing person, it could be a person that helps you with advertising and picking up the business aspects of you know, what you're planning to do. And one of the things that, you know, I'm going to show you in just the next slide here, you know, hopefully you get a good chuckle out of it, but this is really the truth about advisors and sometimes that center of the team.
Let me talk to you about retirement. 401k is the most sound way to go.
Yeah.
Let's talk asset allocation.
You're not going to be able to.
Trust me as your financial advisor.
I'll give you the backstory to it after it's done, and give you.
I have no financial experience at all, and really easy. If they're not a CFP pro, you just don't know. Find a certified financial planner professional who's thoroughly vetted and
with no mic in here, you're not able to hear the sound, but essentially what happened, and you may have seen it on TV, essentially what they did was they rented out a very exclusive building in Manhattan. They scheduled appointments for people who were looking to meet with a financial advisor in this building, and they set up the appointments with this gentleman, and he asked people if they would trust him with their money, and arguably they would say, yeah, hey, listen, you're very knowledgeable, we could tell. And the reality is he's a DJ. He really doesn't know. You know, he cut his dreadlocks for this commercial, and you know, that's what happens out there. And time again, I've heard stories of people hooking up with advisors who they don't even do a background check on them or take a look at them. And you know, there are people who have various complaints against them. So first thing is, if you're looking or thinking about an advisor, or you have an advisor, some of the keys that you want to think about is, number one, a CFP professional. There are only 70,000, sounds like a lot, but it's really not. There are only 70,000 CFPs in the United States, okay? That is one differentiating factor. I'm not gonna say that all CFPs are cream of the crop, but it kind of mitigates some of that risk. And essentially you have to go through about 2 or 3 years of studying and then pass a 2-day, 10-hour exam, and then keep up with about 30 hours of continuing ed each year to maintain that certification. That's one thing. Number two, and we'll go into this in a little more depth in a little bit, if you're working with a broker, okay, somebody who's selling you securities or products and getting paid a commission, there's a website through FINRA, which is the regulatory body there, called Broker Check. If you go on there and you put in your advisor, your potential advisor's name into that engine, it will show you what their experience is, what tests they've passed, if they have any complaints against them. Give you 2 quick stories. One is, this happened to be an author that was looking to work with an advisor. They didn't know about some of these tools. I looked them up on Broker Check. They had 3 complaints against them in the last 5 years. Now, I don't know about their ability, but I know that somebody who's usually good at their craft, if they've been in it long enough and they have 1 complaint against them, I can understand that. But being in the business 5-7 years and having 3 complaints, you know, that's usually a pattern. Another situation, I had a client of mine who had another advisor with money with that other advisor. They came in and asked me to take a look at their portfolio with the other advisor. So I always do like a quick check on who the advisor is to see, just like I did with the previous gentleman, he doesn't come up in the system, no longer there. And then Google him. I find his obituary. He passed away 3 years ago, but for the past 3 years, his name's been on the client's statement as their advisor of record. So shame on them for not knowing, but at the same time, shame on the firm for not letting them. There's a lot of things that broke down there. So it's a good way to just take a quick check to see who they are and what they're about. The other thing is, if they're not a broker and they're an SEC registered or a registered investment advisory firm like my firm is, you could go through the SEC and get what's called an ADV Part 1 and Part 2. It gives you an overview, bless you, it gives you an overview of their background and the practice as a whole, what their asset levels are, and who they're catering to as a client to see if they're a good fit for you. So there are, you know, those 3 primary resources are very good starting places for you to go to kind of vet things out. If you have any questions at any point, don't hesitate to raise your hand. I'll be happy to, yeah, go ahead.
Do you recommend specifically working with someone who either specializes or has worked in the past with authors, or does it matter? I come from a really small town area. There's nobody there that's worked with authors before.
Yeah, that's a good question, and it's one that I get quite often. I wouldn't say that you have to work with or should work with somebody who works with authors, but you definitely would want to work with somebody who has experience working with business owners, because that's a very close parallel to the author community, and I think you need at least that. You know, the other thing is, with technology these days, some of those barriers of coming from a small town are also kind of eliminated. We work with clients, from New York down to Florida, from basically Massachusetts to Florida, as far west as Washington State. We do, video calls and video presentations all the time. So some of that gets mitigated with technology also. But good question. Definitely business acumen, for sure. Okay, so you start writing, right? Then what do? Okay, you're in a position where people are reading, people are buying your books. What kind of business structure? A lot of people a lot of people I see start out as sole proprietors. Some of them continue very successfully and are still sole proprietors. Then if I'm a sole proprietor, should I form a corporation, an SCorp, an LLC? What benefits me? And the reality is here, it really depends on your personal situation, what type of revenue the business is bringing in, and a lot of this decision-making process is really stemmed from the CPA. And you really need to have a CPA. Again, going back to the question, you really need a CPA who's used to working with business owners. You don't want necessarily a tax preparer, and I don't know if you know the difference, but you can do tax returns and be a tax preparer or an enrolled agent. They will tell you they can do everything that a CPA can do, fighting your tax return all the way up the level. But they're really tax preparers. I would highly recommend that if you're really looking to build this entity, you really need a CPA on your team in order to help decipher which one entity or entities may work best for you. And for some it may be an LLC, some it may be an SCorp. I will certainly tell you when you get to a certain size, you have to move away from the sole proprietorship. It's really important that you do that. You really want to start bifurcating your personal money, your personal assets, and the business or the writing practice, if you will.
I have a question.
Sure.
What is then I know some of the tax differences with the SCorp and the SCorp, but is it mainly depending on the size of your business, or?
Most authors, most small businesses will not be C-Corps. Because C-Corps are taxed at a much higher rate than the S-Corps, okay, or an LLC even, because an S-Corp, essentially, you're setting up this corporation. What it's giving you is more or less the protection from being your personal assets. It's now a business entity. And from a tax perspective, as an S-Corp, it really flows back to your own tax return. So you may be paying yourself W-2 wages. If you're doing $500,000 in revenue, let's say, and you have $300,000 in expenses, and you're paying yourself $100,000, that leaves that's $400,000 in expenses against that $500. So there's $100,000 left over. What will essentially happen if you're the only shareholder, that $100,000, instead of being taxed at a corporate rate, which is going to be much higher than a personal rate, that S-Corp will issue a K-1 to you personally, and then you pick up that $100,000 on your personal tax return. So most small business owners will not be C-Corps. They'll typically be S-Corps or LLC for that reason. There are definitely tax benefits there. Does that answer your question?
It does.
And you mentioned that at a certain point, like an author, for example, or maybe a small business, would need to switch from like sole proprietor to something else, right?
Yeah.
Is it typically to an S-Corp or LLC, or what do you see the most? And what is that sort of level? Like,
yeah, it depends
like
on.
$100 this year is probably not enough.
No, definitely no. Definitely not. So I don't know that there's a line of demarcation, so to speak, on that, and some CPAs will feel differently about what that level is. And I hate to use the word hobby, but that's the word that the IRS uses. If you're not deriving enough revenue and you form a corporation, they know why you're forming that corporation, and it could be deemed a hobby by them if there's not enough revenue. But that's a personalized decision. Most folks will look at the S-Corp because of the ease with regards to the S-Corp from a tax perspective and protection. LLCs are more commonplace for real estate type holdings because of the way they're taxed. But if you're writing full time and you're at a point where your revenues are somewhere near what you were, making perhaps as a full-time employee somewhere, that in my mind kind of arbitrarily would be an area that I'd start thinking about making that adjustment or having a conversation, or having the conversation now and preparing yourself for that point in time. Good question. So tax planning, very important, because most of the revenue that is being brought in is not taxed. Okay, you're bringing in this revenue, it's not being taxed. So it's very important that you plan for that. You don't want to get surprised either by not paying any tax and spending it, and then all of a sudden finding out at the end of the year that you have this huge tax bill, or not thinking that you're going to have to pay tax. You may still have it, and then writing a big check. It's very important that, again, coordinating with the CPA, depending if you're a sole proprietor or an SCorp, may determine what you need to do. But in many cases, you're going to have to do some kind of quarterly tax payment in order to stay, in line with what your tax ramifications are going to be. And one question I got from an author probably within the last year was somebody was explaining to her and giving her an argument that you're better off paying less taxes now, taking that money, investing it, okay, and then worrying about the tax ramifications more so at the end of the year. I don't necessarily agree with that. I think that is typically a situation where the advisor is trying to generate revenue for him or herself, because the reality is you have that tax bill. If a client comes to me and I know that they're going to have a tax bill, the last thing I want to do is take their money, invest it in something that potentially when the tax bill comes, that pool of money is worth less, because now you're behind the 8 ball and you don't want to be that. So, always want to make sure that you're setting aside enough for taxes. You should be calculating that quarterly, because you may have a huge, if sales are very big, robust for December or for the holidays, you may have a bigger tax bill come January than after the holiday lull, for example. So you want to be looking at that either on a monthly or quarterly basis to make sure that you're not getting in a position where you're behind.
So then on that note, is it not advisable to do an owner's draw as opposed to doing a W-2?
That's a good, so that's something that you really, again, the CPA will quarterback that. There's certain rules and guidelines that they will run by. At a certain point in time, you're going to not be able to take as large a draw. When you initially start a business and there's less of a certainty of the revenue streams, you may be more inclined to take a draw at that point, or a distribution, as they say. But when you're at a point where you're consistently hitting a certain level, the IRS is really going to want to see you on a W-2 salary wage, because essentially by taking the distributions, you're foregoing paying that 7+% in Medicare and Social Security, which they don't typically like you doing. So there will be a level where you're going to have to make that switch when you have more consistency in your business and the writing.
But then don't you file that at the end of the year?
File what?
Either way, whatever you've drawn throughout the year.
Depends on how your accountant, your accountant may pick up your distributions as W-2 wages at the end of the year, perhaps. I don't know. Everybody does things differently. Or you could be putting yourself on payroll, so to speak, where you're getting a check every month, running through payroll and then doing W-2 that way. So, maybe your accountant may be saying, take your distributions and then we'll worry about the W-2 at the end of the year and then taking care of it that way. But that would only be the case if you were an SCorp, right?
Yeah.
If you're a sole proprietor, it doesn't matter, because basically you're going to get taxed on whatever the net number is after expenses. So that's different. You wouldn't get a W-2 as a sole proprietor. Okay. Now you have the structure in place. You know what the taxes are, And everybody has their own happily ever after, and it's important to work with a financial advisor that's going to help you develop a clear picture. And everybody's picture is different. Some people are worried about retirement. Some people are worried about their kids' education. Some people are worried about a rainy day. That's where having a good financial advisor to kind of bring that picture to life and help you plan for that event. We talk a lot about building outlines for books. You really need to build an outline also for your financial future, if you will. And just like you have an outline for your business plan, you want to make sure that you have a financial plan for that happily ever after. It's not something that you could just wait until 5 years before you're at that retirement date that you have in mind and say, okay, am I okay? You have to really build into that. And the earlier you start planning for that, the better off you are, because the earlier you put away money, the more compounding you'll get, which means you have to put away less money in order to get to the same spot. Or if you need to make adjustments along the way, the longer time period you have to make those adjustments, the better off you are as well. The closer you get to retirement, you have a lot less wiggle room at that point in time. And quite frankly, in this type of business, you could really write, there doesn't have to be a retirement date. You could be writing, in perpetuity, really, if you build a good enough following and a good enough business. But it's very important to have a personal financial plan. And again, going back to that team approach, I see it time and time again where the financial advisor comes in, and a lot of folks that we work with who used to work with other advisors, their advisor would say that they were this coordinator. They were coordinating the CPA and the insurance professional. What they were doing was just saying it. They weren't doing it. Give you an example. We work with a CPA firm on Long Island, and he couldn't believe it because he was sending us some of his clients, and I was asking him for tax returns. And then I had other clients, I was asking them for tax returns and then sending them to him to review. And he said, I can't believe you do this. And I said, what do you mean? He goes, well, I work with a lot of advisors, and they all say, oh, we're going to review your tax return. And he goes, what they do is they pull it out, they look at 3 or 4 lines, and then they throw it in the drawer. I said, well, that's malpractice, because I don't know what I'm really, I know what I'm looking at, but I don't know all the ins and outs. So you really have to make sure that if you have an advisor that's coordinating it, they are doing it, and they're doing what they say. And I will tell you, there aren't that many out there that do it, because this stuff, quarterbacking that stuff, does not necessarily generate them revenue in many cases, and we'll touch on that a little later, but it doesn't generate them revenue, so they're like, we'll tell people we do this, but we really want to get the money to manage. That's really the important piece to them in many cases. So, our practice, one component of it is asset management. So you now accumulate assets, and now it's important for these assets to work for you. Going back to the W-2 question and the distributions, when you're in a position where you're paying taxes, there are plenty of opportunities as a small business owner to set up retirement plans for yourself. And it could be, as little as, putting away a couple $1,000s to as much as $20, $30, $40, $50,000 in a retirement plan. And every dollar you put into that retirement plan is immediately saving you tax money. You may be looking for college savings for your kids, just setting up investment accounts for yourself. Tax deferred versus taxable investing. The more money that you could put away in a tax deferred vehicle, or a vehicle you're not going to have to pay taxes on later on, the better off you are. If you have that revenue stream coming in and you could lower your tax rate now, okay, and then have that money compound for you for the next 5, 10, 20, or 30 years, that's a huge tax benefit to you and a huge savings, and can really accumulate to big dollars and cents for you. Risk management. So this is a very important thing. Another one that advisors miss consistently. And that's, it's great to accumulate all these assets, It's great to mitigate taxes, but how do you protect these assets that you've accumulated from potential risks that may take place? What happens if you're your health deteriorates and you can't write, or you have a disability where you can't type on a computer anymore and you can't get the words down that you need to in the way you need to? There are insurance and risk management vehicles that should be discussed as an option to help protect that revenue stream. How do you protect your family from against not being able to either accumulate assets any longer, or what happens if you've amassed these assets? How do you protect it from either a lawsuit, a predator, creditor, divorce? A lot of us, I'm sure, have children. What happens if your child gets into a car accident and now somebody wants to sue you because you caused harm to either their property? How do you protect these assets? It could mean, life insurance, disability. It could be simple as reviewing your property and casualty, your homeowner's policies, etc., to make sure that your nest egg that you're accumulated is protected from all angles. Because the more money you get, the more people that want the money. It just, it's if you accumulate it and they know you have it and they know you're a successful author, that's, you're going to have friends coming out of the woodwork. So, and actually talking about friends, one question we get a lot of times is, okay, all of a sudden I'm this overnight phenom, I have these royalties coming in. How do you deal with family and friends asking for money? I was actually interviewed by Jamie McGuire, an author, a couple of months ago, and she asked me that exact question. And it's very easy. You blame me. That's what you do. And many of our clients do. They call me up and they say, I want to give so-and-so $50,000. What do you think? I think it's a bad idea. Why do you think? This, and this. I said, listen, worst case scenario, if you don't want to be the bad guy or gal, call them up and tell them that you spoke to your financial advisor, he's advised you against it, and make me the bad guy. And that's what happens, but it's a very easy way. But when you're successful, you're going to have people looking and making those requests. Estate planning, another very important piece, right? You've accumulated these assets. Now, most of us, there are very few of us that want to make sure, if we've accumulated assets, there are very few of us that are willing and able or wanting to give them to other people if something were to happen to us. And usually estate planning is really in terms of, you passing away. If you pass away, what happens to your assets? You have to make sure, or most people should want to make sure, that the assets are passed on to your kids, grandkids, whomever it may be, stay in that lineage so that it's not going outside of the family bloodlines. And it's something that is very easily created. I will tell you with a kind of a asterisk here, every state is different. So, if you're in New York, for example, the estate planning techniques there, probate, if you don't have a will or a trust or anything like that, New York is fairly inexpensive for probate, and you already have a will laid out for you, whether you know it or not. Florida, on the other hand, it's a very difficult state, time-consuming and very costly if you don't have the proper documents in place, and you go anywhere in between. So there are a lot of differences there. But this is something, once you've started accumulating assets, it's something that is very, very important to make sure that your assets that you've accumulated stay within your family and your family bloodlines. Unless you don't want them to, then just roll the dice. But there are, believe it or not, there are a few people that don't really care about that, but most people, for the most part, do. Now, this is going to be very hard to see, but I'm going to try to read it as best I can. I couldn't get the screen much bigger, but one of the things I want to point out, because this is an area that is very, very overlooked right now. And it's something that is coming a little bit into the forefront with some of the discussion, political discussion, and some of the discussion in the news. But on this side, we have broker versus RIA, okay? Now, Has anybody here heard of an RIA or registered investment advisory firm before? Really? Okay, none. And usually you get at least one or two. Okay, so this is going to be very important for you. Most of you are probably used to working with brokers in my field. A broker is somebody who gets paid basically to place a product or sell you a product, and they get paid a commission for doing that, okay? Their level of responsibility to you as a client is what's called know your customer rule. All they have to do is know your facts and circumstances, your income, your risk tolerance, and as long as they're making a recommendation within that framework, they're good to go, okay? An RIA, which stands for Registered Investment Advisory Firm, whole different story. As an RIA firm, that's what we are, we have a fiduciary responsibility to our clients, okay? Which basically means we always have to act in our client's best interests. It's kind of silly if you think about it, right? You think about if people are dealing with your money, they should have to act in your best interest, but they don't. And recently there's been legislation that was supposed to start being enacted April 10th, I believe, but it was kicked down the road till June 1st, where it's going to be supposedly start being implemented and fully implemented January 1 of 2018. That basically says when dealing with people's retirement assets, 401ks, IRAs, the investment professional is going to have to act as a fiduciary, which is still crazy because now all I got to worry about, if I'm working with you on your IRA assets, I have to be a fiduciary and look out for your best interests. But if I'm working on your other monies outside of the IRA, I just have to worry about knowing my client and doing whatever I think is best there. You know, in my view, everybody should be subscribing to this fiduciary standard. There are some unintended consequences of this rule, and one of the unintended consequences are for smaller investors. Because of this fiduciary rule, it's causing increased compliance costs. So there are some firms out there that are saying, hey, we're not even going to work with any retirement accounts any longer because we don't want to act as a fiduciary. But in our opinion, we were a fiduciary before the rule went into place. We'll be a fiduciary after. It's crazy to me that when working with other people's money and advising them and guiding them that you don't have to be, and don't have to be held to the same standard as a doctor, a lawyer, or a CPA. But some of the key differences, all right, brokers and brokerage firms are typically large corporations with national footprints, whereas registered investment advisory firms are mainly locally owned and operated independent small businesses. Account placement, which is interesting. So where do they put your accounts? Well, typically with a broker, they're limited to whatever the broker parent company may be. With an RIA, there's no limit. They can choose any account platform that fits your best needs, okay? On the breadth of offerings, a broker has huge amount of offerings, but they also typically have in-house proprietary products, meaning products that they've manufactured and created, which typically means they get compensated better for utilizing them. May or may not have proven better performance or not, but who knows. Also, RIAs have vast open architecture, so they're not limited. Typically, they don't have proprietary products, typically. On the broker side, the type of professional, a broker is an intermediary between a buyer and seller. That's all. They subscribe to that know their customer rule, whereas a registered investment advisor manages relationships from a holistic perspective across multiple financial topics, which is why, you know, if you're going to look for somebody managing that team, I would argue that they really should come from this side because they're motivated to do that, whereas here, they're really not. Investment decisions, typically a broker will rely on their parent company's recommendations, okay? And I speak to you from experience because I used to work for Solomon Smith Barney back in the early 2000s. And there was a guy by the name of, I think it was Henry Blodgett was the analyst. He was the analyst that covered WorldCom, okay, which we all know what happened to World Cup. And it was the craziest thing. We'd walk in every morning and they had a little squawk box where people would talk about the stocks of the day, things we should be talking about. Henry Blodgett, I don't remember where the stock started, but I can tell you all the way down to 50 cents, the guy was calling it a screaming buy. And we were looking around, I was looking around, I was like, what? I was like, how can we, get on the phone and talk to clients about buying a stock at 50 cents when it was 50 bucks not too long ago, and this guy's more convicted than, has such a strong conviction, but that's how they get you excited, and a lot of brokers are using those recommendations, where the RIAs, investment professional, and basically we are the decision makers. So typically the assets that we're managing for our clients, we're doing so in-house with freedom and flexibility. Nobody's telling us that we have to be doing it this way or another way. We have that open ability. The legal standard, which I talked to you about, the legal standard is limits recommendations to suitable investments, which is pretty wide open. Where the SEC requirement is a fiduciary standard, where we must act in the best interest of the client. Compensation, this is another main differentiator. Brokers are typically paid from commissions, loads on funds, 12B1 fees, finder fees, sales bonuses, mainly generation of revenue from selling a product. Where typically on the RIA side, it could be a management fee based upon assets under management, and or a retainer fee, and or project-based fees. So just to help you understand that a little bit better, our firm has, we have three basic revenue streams. For financial planning and project-based financial planning, we typically charge a flat fee. There's an engagement letter, client knows exactly what they're being charged. Certain instances, we also have a retainer agreement, where if we're managing and quarterbacking, for instance, an author's life, and they want us to be that main person, we'll charge them a monthly retainer to do that, and they know the services that we're providing. It's all laid out in an engagement letter. If we're managing assets for a client, the second way is we would typically get a percentage of the assets that we're managing on their behalf. And the third avenue is the only time we're ever paid a commission at our firm is with life insurance, long-term care, or disability. The insurance industry really has not figured out a way to pay advisors other than on a commission basis. Some cases our clients have pre-existing relationships with a great insurance advisor, and we'll just make the recommendation and help facilitate the purchase there. In other cases, they don't have that good relationship, so we'll take care of it for them. The difference is we will outline to the client and let them know that we're being compensated by a commission, and in many cases even tell them what that commission is. I had a client that I worked with. We wrote a very large insurance policy for him. It was like a $62,000 commission. I, very upfront showed him what it was, and he said, you know what, after the process we went through to get the policy, he's like, you should have been paid double that. It was a long and arduous process to get that done. But much different way of getting compensated. The biggest difference to me is, there's no, on this commission side, there's really no interest or benefit to the advisor of having a vested interest in your success. Okay, it's, hey, I sold you a product. If it doesn't work out, I'll find a new client. Whereas over here on this fee-for-service model, you really have to be delivering service, and you have to be delivering on what you say. Otherwise, the client's not going to pay the retainer any longer, and you're going to have to constantly find new clients. So there is that vested interest on the RIA side. Disclosures, very limited on the broker side. Full disclosure requirements as an RIA, basically because of that fiduciary rule. We have to always, you can't eliminate all conflicts of interest, but any conflicts of interest that exist, you have to disclose them and make sure that the client understands that there may be a conflict there. You can still have conflicts of interest, but as long as the client understands what those are, everybody's setting out on the same page. Proprietary products, we talked about that. Typically none on the RIA side. Could be on the broker side. Education-wise, typically a sales background, more experienced brokers may have some investment education as well. On the RIA side, typically have a investment education and or financial background. So typically a little bit more seasoned there. You know, I think that if you look back at the history of, you know, how the number of advisors out there, you know, as the markets do better, you'll see folks flow from other industries into financial services that may have been in other sales type organizations because they're good at selling. They're not necessarily good at managing the financial stuff, but they're good at selling. And then when things don't do so well, like 07, 08, 09, you know, they end up going into the real estate business and, you know, other avenues and flow out. So, you know, I think that there is some kind of correlation there. And that's all I have for today. Anybody have any questions about any financial topics, either that I covered here or any other situations?
So as a writer, I never know what I'm going to make year to year.
Mm-hmm.
And I do pay estimated taxes. And because the income is like this, a rule of thumb I've often heard is so long as you pay estimated taxes that matches what you paid the previous year, you're
Mm-hmm.
good.
Mm-hmm.
And they're not going to kick up a fuss.
Mm-hmm.
Is that a rule of thumb that you think has?
I believe, I don't know the rule exactly, but there is a rule that says, I think as long as you pay 100 to 110% of your prior year tax liability, you're basically safe and sound. I think it's some number between either 100 or 110% of the previous years.
Yeah.
So yeah,
The other thing that because my husband is very by the book and I'm a little more lackadaisical, and the IRS has these little coupons that say April 15th and
Mhm.
June 15th, and you know, around July I'll say, oh, we haven't paid anything this year, let's just write a check. And I might do that again in November, and I'm done.
Right.
And do they really care if you hit those quarterly? I mean, I'm not talking, I'm not making
They do, because what'll happen is, depending on how again, this is where your CPA comes in, depending upon how you book that revenue that comes
Yeah.
in, okay, you will end up paying, it's not whether or not they care, it's a matter of how much it's gonna cost you. Because if you haven't satisfied that quarterly obligation in a timely fashion, you're gonna pay interest and penalties when you file your return if it hasn't been submitted in that timely fashion. And the reality is, it's getting more and more difficult because, you know, of all the reporting and, you know, all the information out there, that they can very easily find out if, you know, if Amazon is one of the providers. As you know, it's not that hard for them to go down and find out when those revenue streams are coming in and when you should have made those payments. You know, it's not an easy thing, but you want to kind of take a look at your situation and at least start looking at a baseline where, you know, you feel comfortable. Although your revenue may generate significantly, you know, most people who are doing this, I think, somewhat full time get at least an idea of what their minimum kind of revenue stream, outside any major changes that Amazon is, you know, putting the screws on everybody. But assuming that doesn't happen in a given year, then you can at least have a good idea as far as, you know, start planning at least at this level. And then if you hit this level, you know, maybe next year notch it up 10% and plan on that, rather than saying, okay, now I'm going to move my plan from here to here. You know.
Just as an enrolled agent, you're much more suspect if you're sending checks randomly.
Oh, really?
Or if you're sending them quarterly. We will look at you because you're sending them randomly, and we're going to magnify. We're going to magnify what we look at versus if you're sending regular checks on a regular basis. And we do look at if you're sending at least what you did the year before,
Yeah.
then we're much less suspect of you than if you're just giving us something in April and then the next January you say, oh, I'm just gonna send this. We're gonna actually start looking at those dates.
And is it 110% of the
It's
previous?
110.
110% of the
We
previous.
were trying to raise it, but they said no.
Can I ask a
Yeah.
question then? Because I've got another little thing that authors, we sit there and we talk about, but we never
Yes, we
know.
do.
You might know. So, as a writer, my expenses are really low. My
this is your biggest expense, but it's not, because you have a computer at home. You have an office that you use, that you can appreciate and use.
Right.
You have a computer desk, you have supplies that you buy on a regular basis,
Yeah.
that you use, and all of that
Right.
is counted. All of that is counted. And you are always updating laptops, your iPad,
Right.
even if you mostly read on it.
Yeah.
If you're using it for business, you can count it as revenue.
You want to make sure one of the key
Yeah.
components with regards to that is if you're not at a point where you're an SCorp,
Right.
okay, and you're working as a sole proprietor, what we recommend all the time is get yourself one credit card, okay, that you're just using for your author type of expenses. Try not to pay cash or from checks. Try to put everything on that credit card. Pay it off from wherever, but at least you have a running tally of any expenses that you're generating through that author business. Because if you sit down, you and think about it, there are probably other expenses in there that you're not thinking about that could be counted. But when you're a sole proprietor, what's for the house and for me and what's for the business kind of gets meshed together, and you really want to try to keep that separate. Even if you can set up a separate checking account that pays that bill, the more you can separate, the better off you're going to be in the long run. I mean, going back, that infrequency of making the payments, I agree, you don't necessarily want to make a payment in the middle of the quarter per se, but there are certain people that in a given year think their income's very cyclical because they may have a release, which now they have a big bump up, so that quarter they may have to pay a lot more estimated, and then the next quarter things settle down because you're writing the next, so you may not have a release for another 3 or 4 months, and then that cycle's always going to be there, but you definitely it's better off calculating what you think your tax liability is going to be for that given quarter, making the payment and not worrying about it when push comes to shove. It'll make things a lot easier and smoother.
If you are an SCorp, would that same kind of I say principle rule, I guess it's really neither, but maybe a good rule would be to have that separation between, like sometime
well, in SCorp you definitely have to have separation.
Yeah.
Because now it's a separate entity. It's a business. So you don't want to be paying the business expenses out of your personal account. What you really want to do is you want to have a checking account and a credit card in the name of the SCorp and paying those expenses through those.
Okay, so if you do have a personal account that you have to feed into it in order to take care of expenses, is it better to deposit that money into the business and then write those checks or cards from that account as opposed to can it all confuse?
Yeah, what you basically want to do is essentially it's going to be considered, you add money to the company, it's going to be considered a shareholder contribution because you're a shareholder. You're going to make that contribution and then you're going to pay those expenses out of the business. And at some point in the future, if you wanted to recuperate that shareholder contribution, you'd be able to in a very tax efficient way because now you have a listing of all the contributions that you've made over the years to that business.
Okay.
All right.
Suppose you have a like I have a personal investor, but they don't want to be considered as a investor or shareholder because they don't want it to mess up their personal portfolio. I don't really know how to.
What do you mean by that? They've invested in your career?
Right.
So they're writing you a check to keep the business going? They're contributing.
Right.
And then how are you claiming that money? Is it
I think this last time I put it under I don't know if it was shareholder contribution or other income.
I would suggest
Because I did not know how to do it.
You should really consult with a CPA because that's getting a little tricky. You have somebody who's now contributing money. Now at what your biggest concern is that if you want to account for it right on the way in, Because if that investor then comes back and says, hey, I want X number of dollars back now, you want to make sure that that money is going to go back to them in a way that's not going to cause you any, tax grief. So when that starts getting into play, you're really getting down to personal situation, and you really want to make sure it's being accounted for properly. All right. I mean, really, you should be at the very least, meeting with your accountants at least in like October, before the end of the year, taking a look at your situation and putting a tax plan in place for the rest of the year. Taking a look at what revenue and expenses you have. You should be reviewing whether or not there are any opportunities for you to take and make a contribution to a retirement plan on behalf of yourself. It's a very easy way to save yourself taxes and at the same time save money for retirement. Sometimes people don't do it. I had a client several years ago. He had his best year ever in real estate, $1 million in revenue. Okay, his accountant wanted him to put away somewhere like $100,000 in a retirement plan that we designed for him. He was going to save like $55,000 in tax. So $100,000 was really only costing him $45,000. So he's almost doubling his money overnight. Would not do it, for cash flow purposes. But you have to look at things like that. Even if you're not on that large a scale, that's fine. You could start putting away smaller amounts, and it accumulates over time. And that's what it's all about. Again, we're doing this. We want to accumulate assets and wealth to, hopefully one day slow down and then turn, not have a worry or a concern about how much revenue or how much gyrations are coming from the books, but have a revenue stream from these assets that we've accumulated over time. Yeah.
I have one more question. Okay, so if you're kind of still in the upside down mode of more expenses out than coming in, is it wise to make those investments now, or do you wait until you get some leverage?
It's a good question. I mean, it's a personal preference, right? So, I mean, I would say if it's not going to hurt you too much to make the investments, you should, because it's going to only help you in the long run. But then there's the emotional piece to it, okay? When talking with folks that I talk to all the time, the emotional end of it is that they look at it as an expense, which it's not really. So you have to look at it. I mean, if you're not getting a lot of benefit from it, it's really risk versus reward and cost benefit. If it's going to cost me $5,000 but save me $2,000 in tax, then that makes sense to me. If it's going to cost me $5,000 but not save me anything in tax and it's just costing me $5,000, then it's a judgment call as far as whether your own personal situation you want to start putting away that money for retirement down the road. Because it is now in somewhat of a locked box where it can't really be used for your writing practice anymore, and it's there for good reason. You don't want it there and have the ability to do that. Did you have a question?
I just wanted to say thank you for differentiating between enrolled agents and certified public accountants.
Okay.
And financial planners. It amazes me how people will come and say, okay, well, I need a business plan. Like, okay, I know tax law.
Right. Right.
And it really is a totally different thing. And, there really is no crossover. And people think there is all the time. There is not crossover.
Yeah.
We know tax law. Tax law changes enough.
It seems like all the careers that deal with money kind of get muddied a lot.
They really do.
I had a meeting with clients before I came here, potential new clients. They've had a business for 33 years, a pretty successful one. And all they want is they're looking to sell their business now. And they want to know if they sell the business and some real estate, if they're going to have the ability to, live out their retirement goals. And they came to me, all we want is a plan. We don't need anybody selling us more mutual funds. We don't need any more insurance. All we want is a plan. Can you do that? I said, yeah, that's what we do every day. I said, I'm not worried about it. So I said, so what's the definition? Well, I call that an advisor. I was like, okay, but the world out there, advisor, financial planner, investment advisor, to a lot of people, they mean the same thing. And what you have to do is explain and articulate to whoever you want to work with and say, this is the relationship I want. I don't care what your name, I don't care if your title's financial advisor or vice president, because everybody who works for a big firm, they're all vice presidents. I was a vice president at 22 at Solomon Smith Barney. But you know, you have to really outlay what you're looking to do to get out of the relationship, and whatever that title is. And I said to these clients, I said, okay, so you're calling an advisor what I am calling a planner. You need a plan. I said, so now I know what you want and need, and then we tailored the conversation to that conversation. So you have to make sure that the people you're working with understand what your goals and objectives are, and that they're going to cater to that and not switch and start catering to their own agenda, because it happens a lot. So anybody else have any other questions?
Yeah.
Oh, go ahead.
Sorry. That just jogged my memory on something. Okay, if you're in a situation wherein you have X amount coming in, but you have X amount going out, and your X amount ends up being creating, well, at the end of your tax year, you have a loss, right?
Right.
But then, like, if you are working with someone that needs your financial projections or what have you, and they ask you, well, how much did you make last year? Because they were at a loss, did you make nothing, or did you make that gross? You know what I'm saying? Do you use?
It depends. You have to have them clarify. It depends. Some people will ask you what your gross revenue is,
Okay.
and then some people will ask you what your net is. If the gross would be a positive number, then that's going to be a negative number. If anybody has any other questions, what I can do is, my card is in there, okay, on the card. All my information and all our social media contact is on there. We produce usually once every other week a video that I post online with usually some tips for just people in general. So feel free to touch base there. If you have any questions, concerns, feel free to email me. If you take a minute, I'd really appreciate it if you could fill out the survey, if you will, or the feedback form. If you do, bring it up, and we got a nice gift for you that will definitely come in handy after this conference. All right, thank you for your time, and if I can be of any help, just let me know.
Thank you.